Silver hit $121 on Wednesday. By Friday it was at $78. Gold dropped $743 in 48 hours. And here's the kicker. Physical silver coins on eBay are still selling for $180. The market didn't panic. It was pulled. This wasn't some mass sell-off driven by fear or fundamentals. This was a mechanical event, triggered by a rule change most people will never read. Timed perfectly into the Monday open. The CME clearinghouse just raised margin requirements by 36% on silver, 33% on gold. Second hike in 3 days, effective this Monday morning. So let me ask you, who benefits when the cost of holding a winning position doubles right at the top? Because what you're about to see isn't a crash, it's a filter. And if you don't understand what just happened, you're about to get pushed out of the biggest structural setup in 50 years. Stay with me, because I've got the documents, the math, and the proof. Part 1. The rule change that broke the market. Let's start with the thing nobody's talking about. CME Notice 26-041. Filed Friday, January 30th, 2026. This is the smoking gun. This is the document that explains why silver didn't just fall, it collapsed. Here's what you need to know. When you trade futures contracts, gold, silver, wheat, oil, whatever, you don't pay the full value up front. You put down a percentage called a performance bond. Most people call it margin. It's basically a security deposit that proves you can cover your losses if the trade goes against you. Now, for decades, the CME used fixed dollar margins. If you wanted to trade one gold contract, you'd post, say, $10,000. Didn't matter if gold was at $2,000 or $5,000 an ounce, the margin stayed the same. Simple. Predictable. But on January 13th, 2026, the CME switched to a percentage-based system. And this is where things get nasty. Because under the new system, the higher the price goes, the more cash you need to hold the position. It's automatic, it's compounding, and it punishes you for being right. Let me show you the math. One gold futures contract represents 100 ounces. Let's say gold is trading at $5,000 an ounce. Under the old system, your margin might have been a flat 10 grand. Under the new system, your margin is now 8% of the total contract value. That's 5,000 times 100 times 0.08, $40,000. Just to hold one contract. Now here's where it gets worse. On Friday, January 30th, the CME raised those percentages again. Gold went from 6% to 8%. That's a 33% increase. Silver went from 11% to 15%. That's a 36% hike. Platinum up 25%. Palladium up 14%. Let me be clear. This is not illegal. This is procedural. The exchange has every right to raise margins to protect clearing firms. But let's not pretend this is just volatility management. This is a structural squeeze, because here's what happens in the real world. You're a trader. You went long silver at $90. It rallies to 120. You're up 30%. You're winning. Then, on Friday afternoon, you get a notice. Your margin requirement just jumped 36%. You now need to post tens of thousands of extra dollars by Monday morning, or your position gets liquidated. You don't have the cash. Most traders don't. Futures are a leveraged game. So what happens? Your broker force sells your contracts into a falling market, which pushes the price even lower, which triggers more margin calls, which forces more selling. This wasn't the first hike either. This was the second hike in 3 days. The CME had already raised margins earlier that week. So traders who scraped together cash for round 1 got hit again on round 2. And this time, the hike goes into effect Monday, meaning the liquidation cascade happens right at the open when liquidity is thin and volatility is high. Let me frame this differently. Imagine you're playing poker. You've got a winning hand. You're about to rake in the pot. Then the dealer says, "New rule, ante's just doubled. Pay up or fold." You don't have the chips, so you fold. The other guy, who has deeper pockets, takes the pot. The game didn't change. The rules did. And you got pushed out. That's what just happened in precious metals. The goalposts moved mid-game, and the people who couldn't post the new margin requirements got flushed out, whether they wanted to sell or not. This is the invisible lever. This is the mechanism nobody is explaining on CNBC. The price didn't fall because traders lost faith. It fell because traders lost access. Part 2. The WARSH shock versus the real cause. Now, if you turn on the news, they'll tell you a different story. They'll say the crash was triggered by Kevin Warsh. President Trump nominated him as the next Federal Reserve Chair on Wednesday, January 29, 2026. Markets freaked out. Gold and silver tanked. End of story. Here's the surface-level logic. WARSH is a hawk. He favors higher interest rates. He's obsessed with Fed independence and hard money discipline. If WARSH takes the helm, the market expects rates to stay higher for longer. That strengthens the dollar. And when the dollar strengthens, non-yielding assets like gold and silver get hammered. It's economics 101. Fine. I buy that as a catalyst. News moves markets, sentiment shifts. But let me ask you this. Does sentiment move silver 35% in 48 hours? Does a Fed nomination, something that still has to be confirmed by the Senate, by the way, justify a $743 drop in gold? Let's look at the numbers. Silver peaked at $121.64 on January 29th. By January 31st, it bottomed at $78.83. That's a 35.2% collapse in 2 days. Gold dropped from $5,608 to $4,865, 13.2% in 2 days. Go back and look at any fundamental sell-off in history. March 2020, when COVID hit and the world shut down, gold dropped 12% in 2 weeks. The 2008 financial crisis, gold fell 25% over 6 months. Even the 1980 silver crash, the Hunt brothers collapse, that took weeks to play out. This was faster, this was sharper, and this happened in a market where the underlying fundamentals, industrial demand, supply deficits, geopolitical tension, haven't changed at all. So what's the real explanation? It's not sentiment, it's automation, it's forced liquidation, and it's the margin hikes. Here's how it works. Let's say you're holding a $1 million position in silver. Under the old margin rules, you needed to post $110,000. Under the new rules, you need $150,000. That's an extra $40,000 in cash. By Monday morning, if you can't post that cash, your clearing firm has no choice. They liquidate your position, they sell your contracts into the market, and they do it fast because they're not trying to get you a good price, they're trying to protect themselves from default risk. Now imagine that happening across hundreds of traders at the same time, all forced to sell, all hitting the bid, all driving the price lower, and as the price falls, it triggers stop-loss orders. Automated sell orders placed by traders who said, if silver drops below 100, I'm out. Those hit, more selling. Price drops further, more margin calls, more forced liquidations. This is what's called a selling vacuum. It's not driven by human decision-making, it's driven by leverage, automation, and structural rules. The WARSH news may have started the move, but the margin hikes determined its violence. And here's the thing. Clearing firms don't care about your thesis. They don't care if you think silver's going to 200. Their job is to make sure they don't get stuck holding the bag if you blow up. So when volatility spikes and margins get hiked, they pull the plug. Fast. Let me be very clear about what I'm saying here, because I'm not going to pretend this is proven fact. This is analysis. This is interpretation. But the statistical implausibility of a 35% move in 48 hours, combined with the timing of the margin hikes, strongly suggests that this was not a sentiment-driven sell-off. This was a mechanically induced liquidation event. The headline they gave you was WARSH. The real cause was leverage removal, and if you don't understand the difference, you're going to misread everything that happens next. Part 3. The liquidation cascade. Let me walk you through exactly what happens when a margin call hits. Because this isn't abstract. This is the chain reaction that just ripped through the metals market, and most people still don't understand the mechanics. You're a trader. You've got a $1 million position in silver. You went long at $90. Silver rallies to $115. You're sitting on a nice profit. You're feeling good. Then Friday afternoon rolls around, and you get an email from your broker. Subject line, margin requirement update. Margin. Under the old rules, your maintenance margin was 11%. That's $110,000. You posted it weeks ago, but now the CME just bumped it to 15%. Your new margin requirement is $150,000. You owe $40,000 by Monday morning at 8:30 a.m. Central Time. If you don't wire the money, your position gets liquidated. Now, maybe you've got $40,000 lying around. Maybe you don't. But here's the problem. You're not the only one getting this email. Every silver long in the market just got the same notice, and a lot of them are sitting on leveraged positions they can't afford to maintain. So what happens? Let's say half of them can't post the cash. Their brokers start selling, and they're not selling carefully. They're not trying to finesse the market or get a good fill. They're dumping contracts as fast as possible to reduce exposure, because every minute that passes the price could move against them, and the clearing firm could be on the hook. Now here's where it gets ugly. When a bunch of sell orders hit the market at the same time, and there aren't enough buyers to absorb them, the price gaps down. It doesn't drift lower, it falls hard. And when the price falls, it triggers stop-loss orders. Stop losses are automated. A trader says, I'm willing to lose 10%, but if silver drops below 100, I want out. When the price hits 100, the system automatically sells. No hesitation, no second guessing, just execution. So now you've got forced liquidations from margin calls, plus automated selling from stop losses all happening at once. And because this is happening on a Friday into a Monday, liquidity is thin. The big players aren't stepping in to catch the knife. They're watching, waiting, letting the price collapse so they can buy lower. And as the price falls, it triggers more margin calls. Because here's the thing, margin requirements are calculated based on the current price. So if your silver position was worth $1 million at 115, but the price just dropped to 90, your position is now worth 780,000. You've lost 220,000 in value. Your clearing firm looks at your account and says, you need to post more cash to cover this loss, or we're closing you out. More liquidations, more selling. Price falls further. The cascade continues. This is why longs, not shorts, bear the immediate pain in a crash like this. Shorts are making money as the price falls. Their margin requirements are going down, not up. But longs are bleeding, and if they're leveraged, they're getting squeezed out. Now let me be very clear. This is not a conspiracy. This is how the system is designed. Clearing firms exist to prevent defaults. If a trader can't cover their losses, the clearing firm is on the hook. So they have every incentive to liquidate positions early and aggressively. It's risk management. But here's the speculative part, and I'm labeling it as such. The timing of these margin hikes raises questions. Why raise margins twice in 3 days? Why make the second hike effective on a Monday, when traders have the least amount of time to raise cash? Why do it right after the market hits all-time highs? One interpretation, the CME saw extreme volatility and acted to protect the system. Another interpretation, the margin hikes were designed to flush out weak hands and cap the rally. I can't prove which one is true, but the effect is the same either way. What I can tell you is this. Forced liquidation is price agnostic. It doesn't care if silver's worth 50 or 500. It only cares about margin requirements and account balances. And when those two things don't line up, the system sells. Automatically, brutally, efficiently. That's why prices fell faster than fear ever could. Because this wasn't fear, this was math. Part 4. The Great Divorce. Paper versus physical. Now here's where things get really weird, because while the paper price of silver was collapsing on the COMEX, something very different was happening in the physical market. Go to eBay right now, type in 1 ounce silver eagle. You'll see listings for $95, $110, $130, some listings as high as $180 for a single coin. Now check the COMEX price, $78, $85, somewhere in that range depending on when you're watching this. So let me ask you, if silver is really worth $85, why are people paying $180? Why is there a 100% premium on physical metal? Premiums exist for a reason. When you buy a physical coin, you're not just buying silver, you're buying fabrication costs, dealer markup, shipping, and most importantly, availability. Premiums go up when supply is tight, and right now, supply is extremely tight. Let me show you what's happening in the real world. Dealers aren't dropping their prices, mints aren't flooding the market with cheap coins, physical buyers aren't panicking. In fact, they're doing the opposite. They're buying. Because they understand something the futures traders don't. The paper price and the physical price have divorced. This isn't new, but it's getting extreme. The COMEX trades contracts. Pieces of paper that represent the right to silver, but not the silver itself. Most contracts are settled in cash. The buyer takes a profit or loss, the seller does the same, and no metal ever changes hands. It's a financial instrument, not a commodity market. But the physical market is different. When you buy a silver eagle, you get a silver eagle. You can hold it, store it, sell it, it's yours. And when physical supply gets tight, the price doesn't follow the futures market down. It holds, or it goes up. Now let's talk about China, because this is where the story gets global. On January 26, 2026, the Shanghai Gold Exchange was trading silver at $123. The COMEX was at $117. That's a $6 premium. A week later, the spread widened even more. Why? Because on January 1st, 2026, China imposed export restrictions on physical silver. They didn't ban it outright, but they made it much harder to get metal out of the country. And since China is one of the world's largest silver producers, that effectively starved the Western vaults. The COMEX and the LBMA in London rely on a steady flow of physical metal to back their paper contracts. When that flow gets cut off, you get an inventory crisis. And we're seeing it right now. COMEX registered inventories, the metal that's actually available for delivery, have dropped to decade lows. Here's what that means in practice. Traders are starting to demand physical delivery instead of cash settlement. They're saying, I don't want your dollars, I want the metal. And when the exchange can't deliver, the whole system starts to crack. This is the great divorce. The paper market can be manipulated. Margin hikes can force liquidations. Stop losses can trigger cascades. But the physical market doesn't care. It operates on supply and demand. And right now, demand is high and supply is low. So while the COMEX says silver is worth 85, the guy on eBay says it's 180, and the Shanghai Exchange says it's 130. Who's right? Well, here's the thing. Price is determined by the marginal buyer, and the marginal buyer in the physical market is paying a hell of a lot more than $85. That tells you everything you need to know about where the real price discovery is happening. It's not happening in New York, it's happening in Shanghai, it's happening on eBay. It's happening at coin shops and private dealers who are refusing to sell at spot because they know they can't replace the inventory. The central theme here is simple. The price collapsed, but the supply didn't. The futures market got flushed. The physical market didn't blink, and that disconnect is the setup. Part 5. The 50-year setup they can't remove. So let's talk about why this matters long term. Because even if the CME succeeded in flushing out leveraged traders, even if they killed the momentum and scared retail out of the market, they didn't fix the underlying problem. They can't. Because the problem isn't speculation, it's structure. The Silver Institute just released its numbers for 2025. The world ran a deficit of 95 to 215 million ounces. That's the difference between how much silver was mined and recycled versus how much was consumed by industry, investment, and jewelry. And this isn't a one-year blip. This is the 5th consecutive year of structural deficit. Let me put that in perspective. For 5 straight years, the world has consumed more silver than it produced. That means inventories are draining, stockpiles are shrinking, and at some point, there's nothing left to draw down. Now, where are those inventories? A lot of it used to sit in COMEX warehouses, but registered silver, the metal that's available for delivery, has plummeted. We're talking about the lowest levels in a decade. And it's not because demand went down, it's because traders are taking delivery. This is a huge shift. For years, futures traders were happy to settle in cash. They didn't want the metal, they just wanted the profit. But now more and more contracts are being stood for delivery. People are saying, I want the physical, and the exchange is struggling to meet that demand. Why? Because the paper market created claims on metal that doesn't exist. It's fractional reserve banking, but for silver. You've got 10 contracts claiming the same ounce. It works fine as long as nobody asks for the metal, but when they do, the system breaks. Now let's talk about demand. Because this isn't just investment demand, this is industrial demand. And industrial demand is inelastic. That means it doesn't respond to price. A solar panel manufacturer needs silver whether it costs $20 or $200. An EV maker needs silver for electrical contacts. AI data centers need silver for servers and infrastructure. Solar alone is consuming over 200 million ounces a year. EVs are ramping up. AI is exploding. These industries don't have a substitute for silver. They can't just switch to copper or aluminum. The properties of silver, conductivity, reflectivity, durability, are irreplaceable in these applications. So even if the futures price gets crashed by margin hikes and forced liquidations, the industrial buyers keep buying. They don't care about COMEX. They care about securing supply. And that creates a flaw the banks can't break, no matter how many paper contracts they dump. This is what makes the setup structural. It's not about sentiment, it's not about speculation, it's about math. The world is consuming more silver than it's producing. Inventories are draining, industrial demand is rising, and the futures market just flushed out a bunch of leveraged longs who are betting on higher prices. What does that mean? It means the people who couldn't post margin are gone, the weak hands are out, the traders who were in it for a quick flip got liquidated, but the underlying supply-demand imbalance didn't go anywhere. It's still there, and it's getting worse. So the liquidation event doesn't resolve the setup, it delays it, it resets the leverage, it clears out the noise, but the signal remains. And that signal is screaming one thing: there's not enough silver to meet demand. Now, I'm not telling you what to do with your money. I'm not saying buy or don't buy. I'm saying the fundamentals didn't change, the structure didn't change. What changed was access. The door just got smaller, and the people who got pushed out were the ones who couldn't afford to stay in. Part 6. The human and real-world cost. Let's talk about who actually gets hurt when this happens. Because it's not the big players, it's not the banks or the hedge funds or the clearing firms. They're fine. They've got deep pockets. They can post the margin. They can ride out the volatility. Some of them probably made a fortune on the way down. It's the small traders who get crushed. The guy who saved up 20 grand to take a position in silver. The retiree who's trying to hedge against inflation with a few futures contracts. The small-time speculator who saw the setup and wanted in. These are the people who can't post an extra $40,000 by Monday morning, so they get liquidated, forced out, at a loss. And here's the thing, their thesis might have been right. Silver might go to 200. The supply deficit might drive prices through the roof over the next 2 years, but it doesn't matter because they're not in the game anymore. They got flushed out by a rule change they didn't see coming. This is a wealth transfer. Make no mistake about it. When prices collapse and small players get liquidated, somebody's on the other side of that trade. Somebody's buying at 85 what they were selling at 120. And it's not retail, it's institutions. It's the players with the capital to absorb the volatility and the connections to know when the margin hikes are coming. Now contrast that with physical buyers. The guy who bought Silver Eagles at $90 didn't get margin called. He owns the metal, it's in his safe. The price can drop to 50 and he's still holding. He doesn't have to post cash. He doesn't have to answer to a clearing firm. He just waits. Same with industrial buyers. A solar company that locked in supply contracts 6 months ago doesn't care what the COMEX price is today. They've got the metal, they're building panels, the volatility doesn't touch them. But the futures trader, the one playing with leverage, he's out, and he took a loss. Not because he was wrong, but because he couldn't meet the new margin requirements. This is what I mean when I say they're pushing you out. The system is designed to favor size. The bigger your account, the easier it is to weather a margin hike. The smaller your account, the more vulnerable you are. And when the rules change mid-game, the small players are the first to get cut. Let's talk about trust. Because every time something like this happens, it erodes confidence in the price signal. If silver can drop 35% in 2 days, not because of fundamentals, but because of forced liquidations, what does the price even mean? Is $85 the real price? Or is it just the price that happened because a bunch of traders got squeezed out at the same time? Retail investors are starting to ask these questions, and when they lose trust in the futures market, they stop participating. They go to physical, they go to coins, they go to ETFs, and that's exactly what we're seeing. The paper market is losing credibility, and the physical market is gaining it. Here's the final piece. This isn't just about metals, this is about access control. The financial system has always had barriers to entry. You need capital, you need knowledge, you need connections. But when the rules can change overnight, when margin requirements can double without warning, those barriers get higher. And who does that benefit? It benefits the people who are already in. The people who have the resources to adapt. The people who don't need leverage because they've got cash. It keeps the small players out, and it keeps the big players in control. So when I say they're pushing you out of the biggest metal setup in 50 years, this is what I mean. The setup is real. The fundamentals are real, but the access is shrinking. And if you're not prepared for that, you're going to get left behind. Let me bring this all together. On Friday, January 30th, 2026, the CME raised margin requirements on precious metals. Gold up 33%, silver up 36%. Second hike in 3 days, effective Monday morning. That margin hike, combined with the WARSH nomination and a lack of liquidity, triggered a forced liquidation cascade. Silver dropped 35% in 48 hours. Gold fell 13%. Not because the fundamentals changed, not because industrial demand disappeared, but because traders couldn't post the new margin requirements. Meanwhile, physical prices didn't follow. Silver Eagles are still selling for $100 to $180. The Shanghai Exchange is still trading at a premium to New York. China's export restrictions are still in place. COMEX inventories are still draining. The supply deficit is still real. So let's separate speculation from fact one more time. Fact: the CME raised margins. Fact: prices collapsed. Fact: physical premiums exploded. Fact: industrial demand is inelastic. Fact: the world is running a 5-year supply deficit. Speculation: the margin hikes were timed to flush out weak hands and cap the rally. Speculation: this was a coordinated effort to suppress prices. I can't prove that. But I can prove the effect. Leveraged longs got squeezed. Small traders got pushed out. And the big players are still sitting at the table. Here's what didn't change. The long-term structural forces: solar demand, EV demand, AI infrastructure, declining inventories, rising industrial consumption. These forces don't care about margin hikes. They don't care about futures volatility. They keep grinding forward regardless of what happens on the COMEX. So the setup didn't die. It got filtered. The weak hands are gone. The over-leveraged positions are liquidated. The noise is clearing. And what's left is the signal. Monday morning is the filter. The new margin requirements go into effect. More traders might get flushed. Prices might drop further. But here's the thing. The people who survive Monday are the ones who can afford to stay in. And they're going to be holding positions in a market that's structurally short on supply and long on demand. This was not chaos. This was design. Whether you think that design was intentional or just procedural, the result is the same. The door got smaller, the barriers got higher, and the biggest metal setup in 50 years is now only accessible to the people who can clear the new threshold. So ask yourself, are you in or are you out? Because Monday isn't the end of the story, it's the beginning of the next chapter. And the people who understand what just happened are the ones who will be positioned for what happens next.